Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now.
Okay, friends, so Lucid Group just reported earnings, and there's focus on a few things, but the one thing that's getting a lot, especially on FinTwit, you start reading the tweets and people are saying they're going to run out of money in about a year. But I think there's another couple of things that investors really need to be paying attention to looking at Lucid Group. And the single most important thing that I think investors need to understand that I'm going to talk about. This is Jason Hall. This is The Smattering. And let's get right to it. This is just a real quick look at revenue. Like you look right here at the top line and you see revenue last year, $57 million and change. Revenue surged to $149 million. Company delivered about 1,400 cars. You do the math and an average revenue of $105,000 per car that it delivered. Now, you look at the cost of revenue, cost of sales, goods sold is basically what this is. That number doubled. Revenue tripled, but that number doubled. It's still incredibly high. And that's like, okay, you guys got to get to scale. You got to get that number down. You got to generate some gross margin at least before we can even talk about operating margin, which obviously we're a long way from that with almost $800 million in operating loss on over $920 million in total cost of goods sold and total operating expenses. So needless to say, again, it's a completely upside down business right now. We knew that. We knew that to be the case. I want to highlight one other thing up here. 2,300 vehicles they manufactured. Again, they only delivered 1,400, so they manufactured in excess of 900 vehicles. There's a lot of people talking about, hey, are they having a demand problem? Maybe they are. They had previously said they were going to manufacture between 10,000 and 14,000 vehicles this year. Now they're just saying more than 10,000. So they're still refining that guidance. That's important to understand. All right, so what's going on with Lucid right now? They said they've got enough liquidity to get to like the second quarter of 2024, so a little more than a year of liquidity. But the bigger question investors need to think about is, what is the company's path forward when they run out of liquidity, right? When they run out of money to pay their employees, to cover their operating costs, to continue to invest in capital projects, to fund the growth of their manufacturing capacity. And there's a couple of things that I think we need to understand. And number one, I don't think investors necessarily need to think of this as a go to zero investment. I don't think this is a 100% downside investment. I may be wrong. And I certainly hope I'm not. This is not a company. I'll be blunt. I'm not interested in owning Lucid, particularly right now with its cash flow situation where it is. But the biggest reason why I don't think this is a go to zero stock is right here. The public investment fund owns 61%. The public investment fund also has invested $3.6 billion in Lucid since 2018, including in a secondary offering last year, bought $915 million in shares. That's Saudi Arabia. That's the sovereign wealth fund in Saudi Arabia. So I don't think this is a zero simply because the sovereign wealth fund of Saudi Arabia has made a substantial investment in Lucid, including a very recent investment. Again, just the fourth quarter of last year. Now, what does that mean for you as an investor? Again, I'm not interested in investing in Lucid. That doesn't mean you're not. That doesn't mean that you're not somebody that's going to buy more shares right now. And maybe it's going to work out for you. Stock's going to get smashed today. This is pre-market. I'm recording this before the market opens on the 9th. It's already trading down about 9% in pre-market. But here's the key thing I want to talk about. The chances are at some point in the next year, Lucid's going to have to raise capital, right? And it's probably going to do that with a secondary offering or a private placement. Okay, so what's a private placement? Private placement is when it goes to a major investor, often an existing shareholder, and does a secondary offering, creates new shares, dilutes all the shareholders, and this investor buys those shares. Often it will buy them at a little bit of a premium to the market, sometimes right around the market price. The key thing here is it allows that shareholder to acquire a larger stake, generally at a lower cost basis than what they originally invested in the company. So they can kind of average down. And by buying those shares, they're not as affected by dilution as common shareholders as the rest of us individual investors are. And that's probably what's going to happen. That is my best guess is what's going to happen for Lucid. Now, whether that's at this price, a lower price, a higher price, depends on how the market reacts to the performance of Lucid's business going forward. What do you really need to be focused on as an investor? Seeing Lucid figure out how to getting its operating costs as lean as possible while still looking forward and growing. And part of the thing that we don't know, and part of the thing that Lucid doesn't control, is whether demand really is getting a little bit soft. Right? It may seem like it is. There's certainly the bears are saying that's the case. I kind of lean towards maybe that is the reality right now, that maybe demand is not as strong as Lucid was expecting. Again, they've changed the language about their projections for full year production. And 1,400 vehicles a quarter is not going to be enough to pay the bills. We know that. So is it going to manufacture 10,000 vehicles and also deliver 10,000 vehicles and recognize the revenue, generate the cash flow from those? Only time's going to tell. I think the best thing investors can be doing right now with Lucid is watching. This is a really tough industry. The company's in a tough period of trying to grow and going to spend billions of dollars to build out its footprint before it gets to cash flow positive. That creates a that's a lot of headwinds as an investor that makes it harder to really project a future of profitability for the business and a future of profitability for you as a shareholder. To each his own, but I think right now the best thing to do is just watch the company, see if they can make some progress and maybe get to the point where it's investable.